Hey everyone, and welcome. Every single day, there's this giant, complicated machine being steered, our economy. And the people in charge, they really only have two main levers to pull to try and keep it all in course. So in this explainer, we're going to break down exactly what those two levers are and how they shape the world you live in.
So how do you even begin to think about steering a multi-trillion-dollar economy? Well, let's picture it like a massive ship out on the open ocean. Fiscal and monetary policy, those are the two key mechanisms used to guide the ship, to make sure it doesn't sail into a storm or get stuck with no wind in its sails.
All right, so here's where we're headed. First, we'll talk about what steering the economy even means. Then, we'll meet the captain, that's fiscal policy, and we'll pop down to the engine room to understand monetary policy. After that, we'll put them head-to-head to see the key differences, and finally, we'll look at what happens when they work together, or against each other.
And look, I want to be super clear about this. This isn't just some boring textbook stuff. We're talking about the two forces that literally shape your job prospects, the interest rate on your mortgage, and yeah, even what you pay for groceries. This stuff is real.
Okay, so let's climb up to the bridge of our economic ship. This is where we find the captain. And the captain's job? That's fiscal policy. It's all about using the government's budget, basically its wallet, to guide the ship.
So what's the captain actually doing up there on the bridge? Well, fiscal policy really boils down to two things: the government's power to spend money and its power to tax people. It's this constant balancing act, right? Deciding how much cash to pump into the economy and how much to pull back out.
The captain basically has two big levers to pull. The first one is spending. You can think of this like loading valuable cargo onto the ship. The government puts money into the economy by paying for big projects. You know, new roads, healthcare, defense, that kind of thing. And the second lever? Taxation. This is more like collecting fees or supplies from everyone on board. The government takes money out of the system through things like income tax, sales tax, you name it.
So who is the captain?
Well, it's the elected government. Here in the US, that means it's Congress and the president. And as you can probably guess, that makes the whole process super political and often really slow to get anything done.
All right, let's leave the captain on the bridge and head down to the engine room. This is where we find that other powerful force, monetary policy. And down here, it's all about one thing: controlling the speed of the economic engine.
Okay, so what is monetary policy? It's basically all the actions a country's central bank takes to manage the money supply and credit. Now here's the key difference. Unlike the captain up on the bridge, the engineer in the engine room doesn't spend money directly. Nope, they work indirectly by changing how much it costs to borrow money. We're talking about interest rates.
So the main lever down here is the policy interest rate. Just think of it as the throttle for the economic engine. If you lower the rate, borrowing gets cheaper and you speed the economy up. If you raise it, borrowing gets more expensive and you slow things down. But what happens if that throttle is already pushed all the way to zero? Well, that's when they break out a pretty unconventional tool called quantitative easing, or QE. You can think of that as kicking on the reserve fuel tanks. It pumps money directly into the financial system just to keep the engine from stalling.
So who's in charge of this incredibly powerful engine? Here's the kicker. It's not the politicians. It's run by an independent central bank. For the US, that's the Federal Reserve, or what everyone just calls the Fed. And this independence is absolutely crucial. The whole system is designed to protect these big economic decisions from the short-term drama of politics.
And just to give you a sense of the raw power we're talking about here, back in the early 1980s, inflation was totally out of control. So the Fed chair at the time, Paul Volcker, he just slammed on the brakes. He jacked up the interest rate to almost 20%. I mean, can you imagine? It was painful, for sure. It caused a nasty recession, but it worked. It crushed inflation and really proved just how powerful this tool can be.
Okay, so we've met the captain up on the bridge and the engineer down in the engine room. Now let's put them side by side, a real head-to-head comparison, and see how these two economic levers really stack up.
This chart really lays it all out, doesn't it? Just look at the differences. Fiscal policy? That's the politicians. Monetary policy? That's the independent central bank. And that first difference leads right into the next one: speed. Fiscal is slow, it gets bogged down in passing laws. Monetary can be incredibly fast. They can change course in a single meeting. Even their tools and how they work are totally different. One is direct and messy, the other is indirect and works through financial markets.
If there's one thing to take away from that comparison, it's the speed. I mean, this is probably the single biggest difference between the two. A central bank can react to a crisis in weeks, sometimes even days. But getting a big government spending bill through Congress, that can take months, or let's be honest, sometimes even years.
And this all brings us to a really critical point. What happens when the captain and the engine room are working together? And maybe more importantly, what happens when they're fighting each other for control of the ship?
You'd think, right? You'd hope that these two powerful forces would always be working in perfect harmony. But do they always pull in the same direction? Well, if you look at history, the answer is a big resounding no.
And this timeline gives us two perfect examples. On one side, you've got the 1980s, total conflict. President Reagan's fiscal policy was flooring the accelerator with big tax cuts. At the exact same time, Paul Volcker's Fed was slamming on the monetary brakes with those crazy high interest rates to kill inflation. They were pulling in completely opposite directions. Now, flip to 2020, perfect coordination. To fight the COVID recession, the government unleashed massive fiscal stimulus, and the Fed was right there with them, pinning interest rates to near zero to support it.
This brings us to a really serious risk in the modern world, something called fiscal dominance. Basically, what happens when government debt gets just too big. The government's need to keep its borrowing costs low can start to put a lot of pressure on that supposedly independent central bank. It could actually force the engine room to keep rates low just to help the captain manage the massive debt, even if inflation is starting to take off.
And hey, this isn't just some academic theory. Jeff Schmid, the president of the Kansas City Fed, warned about this very thing just recently. He said, the more the lines between monetary and fiscal policy become blurred, the greater risk to the Fed's independence. And that independence, remember, is the bedrock of long-term economic stability.
So here's the bottom line. The crucial point is that this policy mix matters a lot. Whether the captain on the bridge and the engineer in the engine room are working together or fighting each other, that relationship is what directly shapes the economy you and I live in every single day. And that leaves us with one last, really big question to chew on. In this era of record-high government debts and these increasingly blurry lines between policies, who is really steering the ship?